Monday night. I am Anna Dickinson, a senior researcher in the science and tech team here at Onward, and it's my pleasure to welcome you all here. On Friday, we launched our latest paper, Pension Power, which I would encourage you all to read if you have not, and that is the paper that we will be launching this evening. But it is my pleasure to be joined by Tom Tungart, the Security Minister, and also Michael Moore, the Chief Executive for the BVCA. Now, we're delighted that this evening is supported by the BVCA, so what we'll do is we'll have a few opening remarks first from Michael and then the Minister, and then we will open it up to a bit of a panel discussion and then questions to the audience. So, it is a great pleasure to have you all here this evening, and without further ado, Michael, I will hand over to yourself.
Destroy the set, that'll be the end of it. Anna, thank you very much, and to all colleagues here at Onward and the many who've gathered from different walks of life. We're delighted that you're here to join what I hope will be a very valuable, insightful discussion. I quickly and hastily add, not necessarily from anything I will say, but from the contributions from the Minister and what will follow. For those who have no previous knowledge of what I've done, I'm a recovered politician. I spent 18 years in the House of Commons. I was part of the coalition government, and as a Liberal Democrat, that, as I often have to admit, is the reason I'm no longer a politician, because if the coalition was challenging in different parts of the country, it was particularly so in Scotland. There were other things going on as well, I can recall. But from outside Parliament, looking on at what Tom and others are grappling with, what I'm really pleased about is that in the midst of all the challenges, something as tricky and as long-standing as pensions reform is one of the key parts of the government's agenda. For our industry, and the BVCA represents private capital from the earliest, smallest EIS scheme, VCT and VC fund, all the way through to the huge global funds that are based in North America. So Carlyle and KKR are there alongside IQ Capital and Albion. We are that full spectrum of capital. One thing that unites pretty well all of those individuals, those individual firms, is that 90% of the capital that is invested into businesses that are owned, managed by UK-based managers, 90% of that capital is raised internationally. And that has been something that people have celebrated. It's a great success story in its own right. It shows that there's something worthwhile to have and to be part of here in the UK. That's a vote of confidence in both the infrastructure of private capital here in the UK, but also the economic opportunities that are there to be invested in. At the same time, it's a very deep set of source of frustrations for the industry. It's great to go abroad and do the fundraising, but there are large pools of capital here in the UK, and pension capital is at the heart of that, which have been very frustratingly off limits. Now, earlier this year, the government completed some legislation that took care of one of the hindrances, which was about the cost cap in terms of the fees that could be charged across a fund. That didn't exactly open the floodgates, but at least took away an impediment. What was really hugely important, though, was when the Chancellor stood up at the Mansion House back in July and unveiled the Mansion House Compact. At that time, 9, now 11 major financial institutions committing, I've got the numbers from back in July, but these have moved on somewhat, 5% of unlisted equities to be invested, 5% of default funds to be invested in unlisted equities by 2030, potentially somewhere north of £50 billion available to put into startups, scale-ups, growth businesses in the UK. So hallelujah to that. There is, of course, a whole suite of issues that need to be addressed on the back of that. So more recently, we created in our industry the Venture Capital Investment Compact. It covers venture capital and growth equity firms. So from those backing the earliest of startups all the way through scale up and growth, but growth equity in the broader sense, that not only do we have some great opportunities and a need to fund the great science and tech opportunities that are out there. But if you look at the challenges of our age, be it the energy transition, be it the opportunities and, dare I say it, one or two challenges that come from AI, then the whole of the UK economy needs to be reimagined, rewired, and set on the right path. And even before you consider those big secular transformations, there's the ongoing reality that the UK has always been part of a global trading and investment world. It has been celebrated that. Our country's fortunes were largely founded on that approach. To keep that going, we need to ensure that we are attracting all that capital into the UK, but also adapting our businesses to world-class competitive standards. And we're proud that in our industry, the mid-market private equity guys, along with everybody else, are very focused on what makes businesses internationally competitive, as well as looking at particular sectors of the economy that exist or can be developed from academia, from businesses that come out of bigger firms to take ideas forward. So we're neutral about where the capital goes at one level, but we recognise that there is a huge demand for it. So the compact that the Chancellor introduced back in summer, what we're doing now to make that real, because 2030 is still a bit away and there's a lot to be done between now and then. All of that, plus what we hope we'll hear from the autumn statement later in the week, gives us a real confidence that the debate amongst politicians and particularly in the Treasury is definitely in the right place. The Onward report is really helpful in focusing the conversation in all the right places. I think in terms of what it says about structures, about culture, all the things, they look like a kind of to-do list that we at the BBCA have got internalised now for our work on the Investment Compact going forward. So we're delighted at the attention Onward have drawn to this and the intellectual heft that they've put behind it. So lots to be confident about. I hope I've now neatly teed up the Security Minister to tell us how wonderful he thinks the report is and to focus in on where science and tech is. Tom's obviously had an already very distinguished career in Parliament as chair of the Foreign Affairs Select Committee, Security Minister now for a good while, attending Cabinet. It gives him an almost unique perspective on both where we sit today and what the potential is. Ladies and gentlemen, Tom Tugendhat.
Well, look at that. It's very nice to see many people here. It's a Monday night. It's dark. It's just before Christmas. What are we talking about? Pensions, of course. Well, look, it's a huge pleasure to be here. It's a great pleasure to be at Onward. This is an organisation that's very dear to my heart, not just because this paper was written by a former SPAD of mine who went on to greater and better things by coming here, but also because this organisation is one that has been generating ideas and energy into this Conservative government now for a number of years, and indeed supplying, not just stealing SPADs, but supplying SPADs, including to number 10. So it's fantastic that you're all here, and I'm very pleased that Onward has produced this report. And I think it's particularly on brand for Onward because, of course, pensions are fundamentally about opportunity. They're about the compact between young and old. They're about the deal between those with assets and experience and those with ideas and energy. It's a way of transferring effectively. It's the transfer mechanism between generations. That's what we're talking about. And that's why getting this right is so fundamental to the way in which we think about our future and the way in which we think about opportunity. Because for a long time, pensions have been ignored. They've been thought of simply as savings products, thinking just about them for the old. They're not. They're about that wealth transfer. And if you don't get it right, then you get yourself into quite a lot of trouble. And that's where we've started to see some emerging issues here for us too. Because the divisions between young and old, the idea that there is some intergenerational unfairness, is something that has come about in the last few years, maybe in a couple of decades, and an area that actually pensions should be there to resolve. Because the reality is the old don't get the growth in their asset size. They don't get the prosperity they need from their savings if the young don't get the investment and the energy that that capital injection brings. Now, it won't surprise you to hear that I'm very supportive of Onward's report today, because I think they're beginning to answer some of these questions. And I'm delighted to say that I'm giving you absolutely no secrets from the autumn statement, on the grounds that I have no idea what's in it. So I can speak very freely about it, or about the areas that it may be covered by it later this week, with no fear of giving you any tips at all. So look, let's look at the reality of this. We've seen in this country, we've seen some very fundamental changes happen over recent years. And some of those fundamental changes have been exemplified in sort of rather stark ways. Sometimes they've been exemplified by appearing not to be able to control our water industry, or appearing not to be able to control who invests in our nuclear industry, appearing not to be able to have that control over some of our own areas of business. And some people have seen it to do with regulation, and quite understandably have spoken about taking back control from places like Brussels. But not all of it is about regulation. Some of it is about finance, and some of it is about the fact that we have a capitalist system with too little capital. What we fundamentally have is we've drained our pools of capital by moving more and more into bonds and less into equities. I don't know if you know, but the UK has a 5% target for venture capital. In the United States and Canada, it's nearer to 15% in their savings products, in their pension products. That's a very stark difference. And it's a stark difference that doesn't just affect the investment returns. It actually fundamentally affects the way you control the country, because capital is about sovereignty just as much as any regulation or any form of treaty. We know this because we see the way that Ontario teachers have generated returns from our infrastructure, or Australian investors have achieved returns from our water, and the way in which that has meant that we have to negotiate with friendly foreigners, but foreigners nonetheless, as to how our decisions will affect their capital investment. Now that's a big change of control. It's a big change in the way that we look at the length of time over which capital is deployed. If you borrow off pensioners, if you borrow off people who are investing for a lifetime, quite literally, you have a different relationship to capital than if you're borrowing off investors who are looking for a shorter return. So this is one of those areas where we've really got to look hard as to what our pension industry is trying to do and should be doing. And this is why this report from Onward is so important. Because what it's looking at fundamentally is, what is the purpose of capital in this country? What is the point of long-term investment? Why do we have this intergenerational deal? Well, it's fundamentally about making sure that those long-term decisions really can be long-term. It's about making sure that young people with ideas really can access that opportunity. And there are two particularly stark examples, although there are many others that you could describe, but there are two particularly stark examples which really opened my eyes. And the first is DeepMind. Now, I know many of you will know DeepMind as a company based in London and one of the world's most impressive AI companies. And it is both of those things. But it's a company that has been bought by Google. Now, I'm sure Google's a very good company and treats them extremely nicely. But the fact that it had to be sold to Google is pretty staggering. The fact that it had to be sold to a foreign company to achieve the levels of investment it required, rather than seeing its engineers and its developers salami sliced out, is really telling about the level of capital available to investors in the United Kingdom. Now it's a hell of a thing. Because Demis Hassabis and Mustafa Suleyman are two of the most imaginative and creative thinkers in the online space, in the AI space, in the world. And yet they couldn't raise enough to maintain the sovereignty that they wanted over their own company here. So they had to look abroad. The second is Arm. And you'll know, many of you will know Herman Hauser, an extraordinary individual who set up a firm that makes some of the most advanced chips, did a deal with Apple for the iPhone many years ago, and did incredibly well out of it. but again had to look to Japan, to SoftBank, and now is again looking around, or rather SoftBank is looking around for who is going to control it next. Now those are two major strategic assets for the future that really do raise questions as to what control means if foreign ownership means that you are not able to control your own destiny, your own assets. And that's why, as Security Minister, these issues come up. Because this isn't just about what comes under the NSIA, the National Security and Investment Act. It's not just about sovereign control in the narrow sense of encryption technology or those particular assets over which we need absolutely fundamental control. No, it's about the wider question of what does sovereignty mean if capital can only be raised from abroad. Now that's a real challenge. And here we've got to look at what we do next. Now this is where various people have come up with various options and various people have been talking about various ideas. The Chancellor himself has been talking about bringing together pension funds so that you have larger areas, larger pools of capital from which you can look to invest. He's looked at, certainly he's been reported as looking at various different ways of changing the investment rules to make sure that that capital can be used in ways that deepen the opportunity for companies. But I think for all of us, the question has to be, what do we want our pension funds to do? Do we want them simply to return 2, 3, 4, 5% at a bond rate? Or do we want them to return, like Ontario teachers, at 10%, 15% at an enterprise rate, at an entrepreneurial rate? Now clearly, if we want our pensions paid for, but we also want our kids employed, we've got to look at that entrepreneurial rate and not just at the interest rate. Now that raises challenge for us. It raises challenges for the pensions industry to make sure that they're investing properly for the long term and not simply focused on the latest shiny thing. But it also raises huge questions for us as a Conservative government and as a British government, which is how do we release that capital and make sure we get that injection going again. And so, like you, I'm very much looking forward to what Wednesday brings. Because this autumn statement, and again I can tell you this is not me breaching any secrets because I don't know, but this autumn statement really could be absolutely game-changing. There is, according to some estimates, some £2 trillion sitting on the table at the moment, being held by, effectively, government investment in the greatest act of nationalisation that Gordon Brown got through by sleight of hand, by slowly encouraging people to view volatility as risk and therefore to close down pension opportunities. Now releasing that, understanding that the only way to view risk is over the long term and not just over the short, is the way not just to rebalance the opportunity for pensioners, but to deepen the pools of capital for young people and to inject a sugar rush. For those of you who've got 2-year-olds, you'll know what I mean. A sugar rush of capital into an economy that is crying out for that investment and crying out for that opportunity to hire, to innovate, and to shape the future for this great country. Because I think there is enormous opportunity for the United Kingdom. I think we are demonstrating in our university sector, in our entrepreneurial space, in our companies, and in individuals across the whole country, that there is enormous energy. There are huge ideas, and there is real opportunity. The question is, how do we support it, energize it, and see it drive forward? And for that, we need the capital. And you, the pension owners, you have it. So if we tie old and young again, we will see the opportunity coming back. Thank you very much.
Thank you. If we could we'll take our seats at the front, and then is the camera being set up? Okay.
That's where I find out I've said all the wrong things.
No, we just have our tech team sorting everything out. So.
Michael, do you sing?
Very badly, but
Okay, we've had the thumbs up from the tech team now, so I don't think we'll have the chance to hear either of you sing or any of us sing tonight, which will be a massive missed opportunity.
the night is young.
Well, but first things first, but to both of you, thank you so much for your remarks. I mean, there's so much food for thought there. I'm sure the audience is sort of waiting very anxiously to put their questions to you. But as chair, I think I'll reserve the right to ask the first couple if they don't mind. Tom, just to turn to what you were talking about very much I really liked what you said about having a capitalist system that doesn't have capital at the moment, and you've alluded to some of what it is that you think about when you think about sort of national security angle for all of this. But what are sort of the related issues that if we don't unlock this potential, if come Wednesday we don't hear the reforms that a lot of us in this room are anxious to hear, what is the sort of long-term repercussion? Because you were talking very much about we need to think not only about the short term and have short-term investors, but for that long-term planning, what are the considerations that go into this?
Well, look, it's not just Wednesday. I mean, let's be clear. As Michael quite rightly put it, in July the Chancellor set us on a journey, and he's already demonstrated the direction of travel. So we're already engaged in that. But let's be clear. You don't get national security without economic security. It just doesn't work. You can't do it if you're reliant on the kindness of strangers. I'm loving the feedback, but it may just be me. The reality is, if you're... Crikey. Are we... I'll try it without for a moment. Look, we're reliant on the kindness of strangers at the moment, and that's simply no way to guarantee your prosperity into a future. It doesn't work if you're trying to take back control from Brussels only to hand it over to Beijing. It's not appropriate to have dependency in areas where national infrastructure and national investment is urgent or essential for the future growth of generations. And look, we all know that you don't get a single generation to pay for a bridge. You pay for a bridge by having the generations that are going to be using it, investing in it through various forms of investment and return, through various forms of debt and return. That only works if you have the relationship between the living and the still to be born that Burke spoke about. You don't get it unless you get the relationship between generations. And at the moment, that generational link has been shortened to investment time horizon. And much as I know that people criticise politicians for being short-termist, I don't have to look at my investment returns over a quarter. I have to look at them over 4 or 5 years. There are many funds that are genuinely looking quarter to quarter. Surely the best ones are looking longer than that, that's true. But there are many that are looking quarter to quarter. And we need to make sure that we get that relationship better. And the only way to do that is to have long-term money. Because if you don't get long-term money, you get short-term thinking.
No, indeed. And I think sort of tying it into to what Michael was saying, we have the third largest tech sector in the world, behind only the US and China, depending on the metrics you look at it, and the largest pension sector in Europe. So sort of a lot of resource and a lot of potential, but the two don't seem to meet at the moment. And I think this ties in very much to the risk aversion that we've talked about. And so what is it that in the BVCA that you are thinking about, or what is it from the to-do list that you said that we've almost given you through this report that you're looking at or would want to see the sector do to overcome these barriers and this sort of hesitancy or lack of a culture to invest in what the sector at the moment deems as too risky or not what they wish to invest in?
Maybe just worth highlighting some of the really great stuff that already exists. So last year, venture capital and private equity invested £27 billion in UK companies, over half of that in tech. And that number is probably under-reporting by quite some margin, because that's data taken from our members and not elsewhere. There are 2.2 million jobs in businesses, the length and breadth of the United Kingdom, that are backed by venture capital and private equity. 6% of GDP directly, and there will be rather more capable, in fact, proper economists in the room who will point out, by the time you factor in supply chain, consumer spend, you double all those numbers. We have already got a thriving mechanism by which venture and private equity capital gets into the economy and supports what's going on. The frustration is there's the potential to do a lot more. There are 140,000 people in the United Kingdom. Here in London is the lion's share of that, but across the whole country, who are actually working in private capital or very closely engaged in it as advisory community. So we've got, in the largest hub of private capital expertise in the world outside North America, a lot of the tools of the trade. I mean, if we're looking at what we need, it's there. The frustration is about the capital that is available and where we have to get it from. I'm rather more confident in what and where people will invest the capital, because as a rule, we sit in the UK with this very sophisticated investment community, which employs me, so I'm maybe slightly biased in its favour. But it's looking, it constantly needs to make the case to have global allocators of capital put their capital to work through the managers here in the UK. And they are immediately looking for opportunities on their doorstep to put that capital to work. And then, because of the nature of the industry, they are active owners who are looking at the 5 to 6 year growth plan, and also looking at the next owner's 5 to 6 year growth plan, because unless you think about the next owner as much as the current owner, you're not on the right trajectory. So there's a lot of good stuff to highlight already, and the returns are very, very strong. And our argument is that as part of a diversified portfolio across any of our pension pots, it will just add in extra return, and particularly for a younger generation, not so much old guys like me, that's going to be vitally important with the way that things are now skewed to DC. So all that the Chancellor has talked about in the last year, what we expect to see, and what the lists here, consolidation, culture, and capacity, those themes absolutely resonate across. What we are very conscious of, nevertheless, is there is a job of work to do to move from why is it that the culture's wrong? Why is it that we've not got this consolidation happening? So let's not pretend it's next week or the week on Tuesday where this capital is unleashed. But the signalling that is being sent, and the intent, and the hard work that's now going into this, I think can be transformational.
No, brilliant. I think we've got a keen audience who would want to hear more from you, so I will step back as chair in hogging the questions and open it up. So we'll sort of, if hands go up in the room, we'll start taking them in, I think potentially 1 or 2 groups. So we should have some roaming, are we doing roaming mics? Yes, we'll have a roaming mic. So we've got one hand for the gentleman right in front of you, Angus, another in the back of the room, and then I think we'll have a third at the back as well. And if you could also intro yourself and say where you're from, that would be great. So we'll start with.
Thanks very much. Chris Malloy, UK Medicine's Discovery Catapult. I wonder whether the panel agree that this compact statement fires a silent starting gun to create hundreds of fit-to-fund companies in the UK. Because my biggest concern here is if we get this sugar, it will rush to the west coast of the US, because that's where the return on investment might be today, and we will risk not absorbing it. We need to create, do we not, the absorptive capacity for this money to flow before it flows. And to your point, Michael, the things that we need to do in the next 2 or 3 years with the existing resources to create that reality when the money does flow. Otherwise, the risk is we all stand around and say, somebody really should have done something. Is that fair, or is it just sound like carping, which is not supposed to be?
I mean, look, I'd make a very strong argument to say that actually that's exactly what we are doing. And one of the great things that Rishi's been doing as Prime Minister is making sure that the investable environment is here. If you look at the way that Gillian Keegan as Education Secretary has been working with Michelle Donnellan and DCIT and tying together so that that investable climate, it really is ready. is exactly, I think, what they've been doing. And I think when you look at what DPT has been doing as well with Chemi, sort of drawing in that partnership with businesses abroad, I think that is exactly what we have been doing. Look, your point is absolutely valid. You don't want to flood. You want to trickle and increase to a flow. You don't want to flood with capital. You want to make sure that the capital that is coming out can be absorbed. But I think that there is still a pool of capital sitting in investable pots that really could be liberated to feed a lot. And when you look at, I have the great privilege of dealing a lot with the security businesses around this country. And, that's not just sort of gates and locks. That's the most extraordinarily capable tech entrepreneurs and innovators who are looking in 1,000 different ways at the way to make our country safer and indeed our partners and our friends safer. And many of them are doing some fantastic things, and they're getting amazing funding at Angel, at Seed, Series A, B, C. But when it comes to listing, they're still going abroad. And it's that gap, and Rishi, the Prime Minister, has spoken about it himself, it's that gap of taking to full IPO, of getting a company into that second, as it were, into the next tier, that we could do better. Now, the UK is still one of the best in the world. Let's not kid ourselves. But one of the best in the world isn't good enough. We need to be the best in the world at this, and we could be.
I would just say that this source of capital is addressing a number of exam questions, of which yours is a very important one, and I totally agree that the spur of its availability hopefully drives the right action that creates those fit for funding, fit to grow businesses. That really really matters. And you look at the excellence in our academic institutions, you look at the excellence in our existing body of corporates in the UK and the potential to create more from what already exists, it's really very exciting. But point I made earlier on, and without distracting from the focus of the report, which is on science and tech, all of that and more is what we think is. And there's already a dearth of the capital available to fund what is there to be funded just now. So I think we, just to bring ourselves to a comparable state of investment with our peers would be very, very helpful. There was as much North American pension capital money put into funds managed by our members last year as the entirety of UK source capital. So something is happening in North American pension trustee discussions that finds what we have to offer in the UK very exciting. We think there's potential for more, as well as answering your particular challenge.
Okay, brilliant. And we had a question just in the corner here.
Yes, hi, it's Anne Fairweather from Hargreaves Lansdowne. I think a lot of the themes of this report are very familiar, talk around consolidation, culture and the like, but I've just had a quick flick. I couldn't see any recommendations around the regulatory structure. There's often comparisons to these Ontario teachers. Everybody's met them, I think, by now. But to be honest, if you're looking at the DC sort of structure of the pensions industry in the UK, and the regulatory structure above it, is that really right-sized to deliver the kind of investment that you want to see, and what would be your recommendations for change?
We look forward to having very good discussions with the platforms like Hargreaves and others, recognising, as I said earlier on, that there are good reasons why a lot of this has not happened. Our job now in the next year, that's the task the Chancellor has handed us, and if I'm allowed to say this without offending Tom, other political parties are also very supportive of this, and maybe as an ex-Liberal Democrat I'm always in favour of consensus, but I think that gives us a real chance of not getting obstacles in its way that might otherwise wreck the journey we're on. We're looking at three different, or two principal areas of work as we look to advance the investment compact over the next few weeks, never mind a few months. One is actually to set out all the different structures as they currently exist. So we have an established limited partner legal fund structure that works for the existing investors. It's not a plug and play for many in the city, otherwise this might be happening already. So we want to actually make sure we understand what all the structures look like. What are the options? Where's the innovation in that fund structure, those platforms that will allow us to test some of this, and what kind of issues does it spit out? Because at some point we will be able to look at everybody across the table and say, right, these are the 6 big issues, and it may be liquidity, valuations, fees. There's a whole range of things out there. Protection for the saver. I can see, a whole list of them forming in front of my eyes, and we'll say, right, we can work some of this out. Some of it we're going to have to turn back to government and say the regulator needs to take a different view of this if they think that's appropriate, or we might need legislation. But at the moment, government has quite rightly challenged both the pensions industry and the private capital industry to say, okay, there's a disconnect here. Show us how you could get rid of it.
No, indeed. And we had a question right at the back there in the middle.
A quarter of all small and mid-cap companies don't believe it's viable to be listed. Recently, there was a survey of entrepreneurs who are probably before the D stage of funding, were surveyed by the Adam Smith Institute. Over half of them said they wanted Labour to win the next election. We also have had a number of problems in the city, like overburdened corporate governance and the poor performance of our audit sector, which has led to a number of financial scandals. Perhaps the largest being NMC Health, which was largely forgotten because of COVID. How can we create a stable political, regulatory, and tax climate where we can back investment when corporation tax rules chop and change? Sometimes under Liz Truss, this became almost a daily occurrence. We also have a number of issues facing our country, like the unreformed planning sector. I know we always talk about in terms of the housing crisis.
Sorry,
but
could you just...
But it's also meaning that we can't build laboratories for our life science sector. How can we get the basics right, the strong regulatory underpinnings, so we can invest in exciting things?
Okay,
Shall I pick
two
that up?
parts to that.
Look, I mean, I think there's some really interesting work been going on here, and actually one of the things that I've been hearing, and it's been reported, so I can tell you, but it's something that comes up at Cabinet quite a lot, which is the work that Michael Gove's doing on planning reform and on building things like laboratories and increasing laboratory space around Oxford and Cambridge in that particular cluster, but also actually around the Imperial cluster in London. And making sure we have that investment, I think, is incredibly important. And this is where, to the question that we come up with is, why is this a security issue? Why is this a whole of government issue? Because this isn't just about financial investing. It's not just about financial regulation. It's about having the investable climate and having the environment which can take that, as it were, that fresh water. And here, I think the government is exactly in the right direction. And this is, I pay huge credit to my colleagues who are responsible for these various different areas to make sure that we continue down this path. Because actually, I think that's exactly what this government is doing. Now, I've seen reports. I don't know whether they're true. As I say again, I haven't been privy to the autumn statement. But I've seen reports about full expensing being spoken about. That would be a hell of a commitment to long-term investment. It's something I spoke about a year ago. But there's a whole series of areas there where I think that the government is definitely thinking about, and maybe even we'll see on Wednesday, but maybe even looking towards acting on some of those fiscal areas, but is already acting on many of those physical areas. If you look at the investment that we've put in through Michael's reforms, and we look at the way in which we're changing the energy climate to make sure that we can get long-term energy contracts and the plug-in system that the National Grid has sadly struggled to achieve through electrical plug-in system over recent years.
Do you wish to have a follow-up, Michael?
From the point of view of what our members are looking for, at a very high level, it's a recognition that we have the capability and the track record in the UK to deliver something hugely beneficial, not just for pension savers, but importantly to boost that 2.2 million jobs to some new level, to address some of the base, to take the risks that often are pretty daunting for those who have got less experience of using venture capital or private equity, and make sure that we are rewiring the whole economy as well as finding the opportunities for the future. But I think the essence of the question, if I'm allowed to paraphrase it, is how do we get predictability? How do we get the consistency? And whether we're here talking about persuading allocators of capital across the world to put it to work here in the UK and find its opportunities here in the UK, or more prosaically just make sure that every business in every part of the country has got the confidence to put the investment into a new building, a new service line, going international, whatever it might be. All of that needs predictability. Having said that, I do recognise that politics being a messy business at best, some of that predictability can be hard to deliver. But the optimistic point is there's a huge amount of opportunity here, and the framing that's being done at the moment is giving us some encouragement that we can get to the right answers.
Yeah, and on the lab space point, I would also point anyone in the direction of our Wired for Success paper, which we discussed that in a bit more detail, which came out in August. But we'll do another round of questions if there's hands. Oh, we've got quite a few. So we've got 2 over here, and then another one in the sort of third row over there. 2 over here, and then 1 there.
Hello.
Good.
Shall I go first?
Yeah.
Daniel Clark, Policy Manager at Tech UK. Given that London gets around 80% of UK VC investment into UK tech, and given the fact that clustering is very important in technology, see Silicon Valley, for example, do you think that's a problem? And if so, how would we solve that?
Okay.
So clustering is important, but London isn't the only cluster. If you go to Newcastle, you'll see some of the finest devs and engineers that not just the UK has on offer, but the world has to offer. And you'll see that you also get a very different runway if you're looking at investing in young people in Newcastle than investing in young people in London. No fault of their own, but the cost of living, the cost of housing and so on means that the runway can hire different people over a longer period because of the change of geography. And so I think, yes, you're right about clustering, but that doesn't mean the UK has to have only one cluster. And one of the great strengths that the UK has is that we have many: Bristol, Newcastle, Oxford and Cambridge and so on.
And I'm just going to throw in, accent will give it away,
Glasgow,
a plug for Glasgow, Edinburgh, Heriot, Watt, Napier, Dundee, St Andrews, etc. I think the ultimate, the serious point is that I'm not quite sure I accept all the numbers there, but I'd be happy to have an offline discussion about that. But the preponderance of that investment into London or into the Golden Triangle even, nobody would challenge. But let's also recognise that the Golden Triangle does some of the world's leading science, has been getting itself, to borrow the phrase, fit for funding and fit for growth for a lot longer. I think back to being a constituency member of Parliament and a government minister a decade or more ago, the conversation has been transformed. But we're still a long way away, apart from perhaps in small parts of the Golden Triangle, from the kind of experience my brother-in-law gets in the Bay Area in San Francisco, where he is over an hour from Stanford, and yet his neighbourhood is full of software engineers, startup people, contractors. I live an hour from Edinburgh. I come down and back every week for the day job, and I do not live among software engineers and other things. We're on a journey, so we need to change it. But I think we'll do it best by showing the opportunities and building the system around those universities and others to make it work.
Indeed. And we had another question in the back there, if you pass the microphone, and then we'll sort of go around in a semi-circle.
Thank you. Excuse me. Richard Williams from the University's Superannuation Scheme. We're one of the UK's biggest pension funds, and we've got about a third of our assets in private market in our DB fund, and in our DC default fund we're well ahead of the 5% target. In the Mansion House Compact, we're at 20%. Now, it often feels sometimes that there are two separate conversations going on. There's excellent reports like this and events like this. I see 1 or 2 familiar faces from the pension sector in the room, but there's different sectors saying, we would really like to get more pension capital, and it unlocks all these really good things, and it comes up with lists of recommendations. There's a separate conversation going on in the pension sector quite often saying, we're interested in investing in these type of things, here's good examples that people are doing, and here's what we would like. And those lists never quite seem to marry up. So there's a report this morning from the Pensions and Lifetime Savings Association that's listed a few things. How do we get the debate beyond that and actually bring that together? Because my fear is we get announcements on Wednesday that don't quite do everything that we hope they might do.
You're right to draw that out very elegantly, and I should disclose that USS are big members of the BVCAs, and we're delighted your engagement with us. But I think, so after the Mansion House Compact in July, the Treasury got in touch and said, so they've done their bit, what's your industry going to do? And so we sat down and worked out what looked like a good response to that, welcoming what had been going on, and also acknowledging that there are issues to resolve, so those lists don't overlap. And so we launched the compact under the watchful eye of Gareth Davis as Treasury Minister, and the very next day I followed, the Chancellor was interviewed by the then Lord Mayor about the direction of travel on this, after which I was on a panel with others talking about what the opportunities were. The whole morning was spent with, dare I say it, people asking quite hard questions from the pensions industry of us, and vice versa, us saying, right, but here's some counterpoints to that. That was an actual set of conversations in a room which we now, with our expert panel and the working groups that are going on behind that, and on the assumption that the PLSA and ABI and others who we've had meetings with in recent times, along with the corporation and others, if we, government will hold us to account for working to get those lists unified and then serious answers to the questions on them, then I think we can make progress. We have got a rare moment in time to take advantage of the fact that there's a problem that we can solve collectively. Let's not waste it.
Brilliant. We had a question in the back here, and then we'll...
My name is Bjorn Savin. I'm the founder of IK Investment Partners. So I have a little longer perspective, but I could say that the key issue here is we have had a lower growth rate in the UK and in the EU for decades. So what is the magic moment? What happened in the States? Well, what happened wasn't exactly what's being proposed here. I think with doubling up from 5 to 10%, the same has happened in Sweden. The magic moment was the prudent person rule, so that the institutions, the pension companies, the life insurance companies could decide for themselves what was the adequate level at which they would get the right level of return profiles for their members. That brought all the money into the venture capital companies, the growth equity funds, the private equity funds, and that has led to their dominance. And all of us operators, even if we have a few big ones in the UK and in France and in the rest of Europe, Europe and the UK as a whole is so far behind the US. Maybe we're a third, maybe we're a fifth, but the need for action is actually bigger, because at the end of the day, the US investors always have, they also think maybe 10% for UK and Europe, maybe 20, but not more. So the US is still much more funded, even with the change that's being proposed. And I really think the prudent person rule is a better solution. Thank you. I would like to hear your comments.
I'd love it if it delivered that level of capital into the industry. And I mean, IK have obviously worked really hard over the years to establish the track record of the industry and show that here there are proper returns that are generated. I think what you're hinting at, or maybe not so much a hint as a direct challenge to, is the kind of culture of pension investing and so on that has existed in the UK. And I get it. I think I heard somebody say recently, pretty well all regulatory changes in recent years have nudged risk aversion, further and further towards reducing and eliminating risk. That is understandable. When people will be accountable for why something has failed or otherwise. So there's a whole bunch of cultural changes that are needed on that. But I like the idea. We might recycle it and pop it into other conversations.
But 5 to 10 is good.
5 to 10 would be better than we have at the moment by some margin.
So look, I think there's an illusion. There's an illusion that you can eliminate risk, but risk is like energy. It can neither be created nor destroyed. All you can do with risk is transfer it. You can either have it early, in which you have an opportunity to fix errors, or you can have it late, in which case you just have to see what happens because you won't have time to fix it. And the challenge that we've got is that we have diminished volatility and therefore increased long-term risk. Because the reality is, having a volatile pension product early in your career, in your 20s and 30s, means that if it goes awry, you have time to invest more or to change your investment profile. If it turns out that actually you simply haven't invested in your economy over 30 or 40 years, and you have reduced the growth of your economy by withholding the oxygen of investment, then what you've actually done is you've injected much more risk further down the road than the volatility you removed early on.
It's a risk that people don't talk about. They can risks they can identify and see, losses they can see crystallized now. All of that is understandably front of mind. The risk of not getting a retirement income that you can live off is something that occurs too late in life.
Well, that's exactly right, and that's why it's also a risk to the security of the state, because if you have not invested in the technology today to compete with China on AI or somebody else on another area, you find yourself way behind the curve. And you can't sprint to catch up. That's a 30, 40-year investment. What you need to do is you need to accept that young volatility is different from deep and abiding risk.
Yeah, and for those who have already read through the paper, you will see that the calculations made have estimated that if these reforms come through, the average pensioner could see it's £98,000 extra in their pension pot over the course of those 30 years, so quite a significant amount to be returned. We had a question there in the third row as well.
Good evening, Rob Reynolds, Intermediate Capital Group. I guess two brief questions. One, Tom, I totally agree. I think, as ultimately a pensioner, I want to receive the best total return net of fees. I don't want gilts that might be cheap and get me 5%. And I don't actually think fees is the big issue here with private markets. The fee caps on DC are high. What I think the issue is that DC funds win business by being quite cheap, and they get priced out if they charge more than 15, 20 basis points for management fees and expenses. So how do we bridge that gap? How do we convince people that total return net of fees is the right outcome? And my second point, which is perhaps a little negative, is I think this issue gets worse before it gets better. We've got $1.5 trillion in DB pension funds, which are very quickly going to the annuity market, and which is by definition investment grade. It's not equity focused. They're not just not investing in privates, they're actively selling in the secondary market. So I think it gets worse before it gets better. Open comment.
Thanks for depressing us all. The serious point there is, I think now the fees debate has moved on, but I know it's on top of the list. Those mismatched lists that we were referencing earlier on, fees, we think have got a good thing to talk about. It's the value for money, it's the returns you get net of those fees that should be the focal point. Then there's a retort that says, yeah, but you're going to charge me a big upfront fee and I won't see my return until somewhere in the future. So that goes to a third theme of the work that we're now undertaking, which is the cultural differences are also founded on, frankly, some quite strong levels of lack of awareness about what has actually been happening. And I'm willing to put my hands up and say our industry will have to learn more about what's going on in DC world, in the same way that I hope people will be receptive to learn more, because I think the returns net of fees are powerful, and as part of a diversified portfolio, they're going to do the job. Sorry, the second question was yeah, so you're right. There's if we don't break out of this kind of problem, the pincer movement of both those trends going in the wrong direction will be particularly bad for us, and it will be bad. My contention is it will be bad for savers, and also ultimately bad because we will lose a productive source of capital. But we have for generations now, 40 years and more, been showing to international investors that through investing in the UK economy and other parts of Europe, they can deliver brilliant returns. That fundamental, hopefully, can be better understood more widely. But we've got quite a bit of work to do quite quickly.
Indeed. And I think that unless there's any final comments from either of you, that does sadly bring us to the end of this question and answer period, because it has been incredibly fascinating. So just to close off from myself, I have a couple of thank yous. First of all, thank you to the BBCA for supporting this event this evening. Thank you to you both, Michael and the Minister, for joining us this evening and for your contributions, which I'm sure have fascinated the entire audience. But also lastly, thank you to the audience for your questions, for turning up on what was a drizzly Monday night, and for not demanding too much insight from the Minister for what may come on Wednesday and beyond. So thank you, and thank you to all of you.
Thank you.